Welcome back, students. Let us start the new point, and in this part I am going to explain about cooperative banks, development financial institutions, discount and finance house of India, unorganized sector. This is the introductory things that I am going to explain it to you. First, we will see the cooperative banks. Cooperative banks came into existence with the enactment of Cooperative Credit Societies Act of 1904. Cooperative banks supplement the efforts of commercial banks by meeting the credit needs of the local population. This is important, local population. It fulfills the banking needs of small and medium income groups. The cooperative credit sector comprises of cooperative credit institutions such as primary cooperative credit societies, district central cooperative banks, state cooperative banks, etc. See, look at the figure, the structure of cooperative bank. This is a primary level, primary cooperative credit societies, district level, district central cooperative banks, and state level, state cooperative banks. This is apex banks. Okay, this is the structure of cooperative cooperative societies or cooperative banks. Okay, this is a three-tier structure. Second, development of financial institutions, DFI. Development of financial institutions are agencies that provide medium and long-term financial assistance. Understand, this is medium and long-term. They help in the development of industry, agriculture, and other key sectors. Industrial Finance Corporation of India, IFCI, was the first development financial institution to be established in 1948. Development financial institutions have diversified their operations with the advent of liberalization and globalization. They have set up subsidiaries to offer a wide range of new products and services such as commercial banking, consumer finance, broking, venture capital finance, instrumental finance, e-commerce, etc. So, development financial institutions are in the process of converting themselves into universal banks. RBI has issued guidelines for the development financial institutions to become commercial banks. For example, ICICI, Industrial Credit and Investment Corporation of India, has become universal bank by a reverse merger with its subsidiary, ICICI Bank. Discount and Finance House of India, DFHI. The Discount and Finance House of India was set up in 1988 as a money market institution based on the recommendation of Waghal Committee. It is jointly owned by RBI, public sector banks, and financial institutions to impart liquidity to the money market instruments. Unorganized sector. These, whatever we discuss now, they were organized sector, right from RBI up to Discount and Finance House of India, all are organized sector. Now, unorganized sector. The unorganized money market in India comprises of indigenous bankers, money lenders, and unregulated non-bank financial intermediaries. The activities of unorganized money market are largely confined to the rural areas. They are in the rural areas. Indigenous bankers. They are financial intermediaries that function similar to the banks. They mostly deal in indigenous short-term credit instruments such as hundi. The rate of interest differ from one market to another market. indigenous bankers are mostly confined to the certain social we can say that strata, that is different levels. They are an important source of funds in unbanked areas and provide loans directly to agriculture, trade and industry. This is indigenous bankers. Second, money lenders. They mostly operate in villages. Money lenders usually charge a very high rate of interest. The loans provided by money lenders are for both productive and unproductive purpose. Agricultural laborers, small and marginal farmers, artisans, small traders, etc., usually borrow money from the money lender. At present, the activities of the money lenders have been restricted by RBI due to their exploitative tendencies, because their rate of interest are very high and they exploit the agricultural laborers or small farmers, artisans, etc. And the last, unregulated non-banking financial intermediaries. They include chit funds, nidhis, loan companies, etc. Under chit funds, members make a regular contribution to the funds. Bids or draws are made on the basis of a criteria mutually agreed upon by the members. Accordingly, the collected fund is given to the chosen member. Chit funds mostly operate in Kerala and Tamil Nadu. Nidhi is also the type of mutual benefit fund thriving on the contributions of its members. So these are the unorganized form of money market. This is first is indigenous bank, then second is money lenders, and third is unregulated non-banking financial intermediaries. Students, one thing you have to understand, that whatever we have discussed in the organized one, that is RBI, then commercial bank, and then cooperative banks, then developmental financial institution, discount and finance house of India, they are organized sector, and these three are unorganized sector of Indian money market. Thank you very much.